Hello and welcome to our video on the top 10 strategies for stock market investing. In this video, we'll be discussing some of the most effective strategies that you can use to invest in the stock market and maximize your returns. Before we dive into the specific strategies, it's important to mention that investing in the stock market carries inherent risks, and it's important to do your own research and make investment decisions that are appropriate for your individual financial situation and goals. It's also important to remember that past performance is not indicative of future results. As always, make sure to like and subscribe to the channel to stay up to date on all of the latest news. Now let's get into the top 10 strategies for investing in the stock market. Number 1. Diversification. One of the most important strategies for investing in the stock market is diversification. This means investing in a variety of different types of stocks, such as large cap, mid cap, and small cap stocks, as well as stocks in different sectors and industries. Diversification can help to reduce the risk of your portfolio, as the performance of one particular stock or sector is less likely to have a significant impact on the overall performance of your portfolio. For example, if you only invested in technology stocks and the tech sector was to experience a downturn, it could have a significant negative impact on your portfolio. By diversifying your investments, you can mitigate this risk. Number 2. Long-term investing. Another effective strategy for investing in the stock market is to take a long-term perspective. This means holding onto your stocks for an extended period of time, rather than trying to trade them frequently. By taking a long-term approach, you can benefit from the potential for long-term growth and compound returns. It's important to keep in mind that the stock market can be volatile in the short term, and it's not uncommon for stock prices to fluctuate significantly over the course of a few days or even hours. By holding onto your stocks for the long term, you can potentially ride out these short-term fluctuations and benefit from the potential for long-term growth. Number 3. Dollar cost averaging. Dollar cost averaging is a strategy that involves investing a fixed amount of money into the stock market on a regular basis, such as every month or quarter. This can help to smooth out the impact of short-term price fluctuations and reduce the risk of buying at the wrong time. For example, let's say you have $1,000 that you want to invest in the stock market. Instead of investing it all at once, you could choose to invest $100 per month for 10 months. This way, if the stock market experiences a downturn, you'll be buying at a lower price and potentially get a better value for your money. Number 4. Value investing. Value investing involves identifying stocks that are undervalued by the market and buying them with the expectation that they will eventually be recognized as being worth more than their current price. This strategy is based on the idea that the market is not always efficient and that there are often opportunities to buy stocks at a discount. To identify undervalued stocks, value investors will often look for companies with strong financials, such as a low price-to-earnings ratio or high dividend yield, that are trading at a price that is below their intrinsic value. Number 5. Growth investing. Growth investing involves identifying companies that are experiencing rapid growth and buying their stocks with the expectation that this growth will continue. This strategy is often focused on companies with strong financials and a history of strong earnings growth. Growth investors are typically willing to pay a premium for the potential for future growth and may be more willing to accept higher levels of risk in exchange for the potential for higher returns. Number 6. Income investing. Income investing involves buying stocks that pay a steady stream of dividends, with the goal of generating a regular income from your investments. This can be a particularly appealing strategy for investors who are looking for a steady source of income in retirement. There are a few different ways to approach income investing. Some investors may choose to focus on high-yield dividend stocks, while others may opt for a portfolio of stocks that pay a lower yield but have a history of consistently increasing their dividends over time. It's important to keep in mind that dividend-paying stocks may be more vulnerable to market downturns, as companies may choose to cut or suspend their dividends in times of financial stress. Number 7. Sector investing. Sector investing involves focusing your investments on a specific industry or sector, such as technology, healthcare, or energy. This can be a useful strategy for investors who have a particular interest in or expertise in a particular sector. For example, if you have a background in the healthcare industry and have a strong understanding of the trends and challenges facing the sector, you may choose to focus your investments on healthcare stocks. It's important to keep in mind that sector investing can be more risky than a diversified portfolio, as the performance of a particular sector is likely to be more influenced by specific factors within that sector. Number 8. Index investing. Index investing involves buying a basket of stocks that track a particular index, such as the S&P 500. This can be an easy and cost-effective way to get exposure to a broad range of stocks without having to pick individual stocks. For example, if you wanted to invest in the S&P 500, you could buy an index fund that tracks the S&P 500, rather than trying to select individual stocks. One advantage of index investing is that it can provide diversification with relatively low fees. However, it's important to keep in mind that index investing does not offer the potential for outperformance and may not provide the same level of returns as actively managed portfolios. Number 9. International investing. International investing involves buying stocks and companies located outside of your home country. This can be a way to diversify your portfolio and take advantage of the potential for growth in different regions of the world. International investing can be more complex than investing in domestic stocks, as it may involve currency exchange risks and the potential for political and economic instability in different countries. It's important to carefully research the companies and markets you are considering investing in, and to be aware of any additional risks that may be involved. Number 10. ESG Investing. ESG investing, or environmental, social, and governance investing, involves prioritizing investments in companies that prioritize sustainability, social responsibility, and good governance. This can be a way to align your investments with your values and make a positive impact on the world. ESG investing has gained popularity in recent years as more and more investors are looking for ways to invest in companies that align with their values and have a positive impact on society and the environment. It's important to note that there is no one-size-fits-all definition of what constitutes an ESG investment, and different investors may have different priorities when it comes to ESG criteria. We hope this video has provided you with some useful strategies for investing in the stock market. Remember, it's important to do your own research and make investment decisions that are appropriate for your individual financial situation and goals. Thanks for watching, and be sure to like and subscribe for more helpful financial tips. We'll see you next time.